Good morning, everyone. Welcome to our first DVD client presentation. Now, in the last couple of years, Mike and Gabe have come over to El Centro and we've done a client appreciation luncheon, but only about a fourth of my clients have been able to attend that. So this time we thought we'd try something new and put together our own little DVD that talks about what we're doing and our investment strategies. Just sit back and relax, get some popcorn, some soda. We're just going to talk about the economy and our investment strategies. So at the end, let us know what you think of it. Now, our first speaker today is Gabe Wisdom. He started our organization 15 years ago. He's very well versed in investment matters, has written numerous books and articles. So we're glad that he can join us today. So now I'd like to introduce Gabe. Gabe?
Thanks, Jim, and hello, thanks for watching this video. I want to talk about American Money Management's investment principles because this is really where we start in constructing a customized portfolio for you. The most important decisions that we make are asset allocation. What percentage is going to be in stocks, bonds, alternative assets, cash, real estate, and so on. Also, volatility. We have to address the fact that volatility makes our clients nervous, especially the downside kind of volatility. The headlines that make markets go down or make people nervous usually present the greatest buying opportunities that we have. So we look to anticipate this kind of really favorable volatility, but we have to manage our expectations for volatility and be ready to take advantage of it when it occurs. The price that we pay for things determines the rate of return. We look at spreadsheets, we look at various valuations. This is what we do all day long, really. And time, you think about your best investments that you've ever made, ever. They were the good quality investments that you may have been tempted to sell from time to time, but you let time be your ally. Then over time, the book value, or then the intrinsic value, let's call it, rises as we get compounded earnings and revenue, as we get a rising equity value. And then finally, we've learned over many years, you just cannot predict the future when it comes to current events, surprise events that may occur. Investing is based on certain fundamental financial principles, but also there's emotion and global, national events that occur. And we know that we can't predict those in the short run, but we're ready to act when and as they occur. That's our objective, and I want to thank you for being with AMM, and thanks for your time. And now I'd like to introduce our partner, Chief Investment Officer, Michael Moore.
Now I'm going to talk a little bit about our big picture view. And you can refer to page 3 of the pamphlet. Our big picture focus is trying to understand today. That's really our goal as investors. We know we can't have a perfect crystal ball, but if we can understand the current environment, we think that can help us position portfolios accordingly. What we've seen from 2009 up until present, a very aggressive Federal Reserve keeping interest rates very low, being very aggressive about trying to grow the money supply and support the overall economy. This has had some very positive effects. We've been in the 5th longest economic recovery since the Civil War. What we've seen is asset prices of all kinds all appreciate quite significantly, and this has had somewhat of a positive effect. We call it the wealth effect. Asset prices go up and people feel better. But there's been some distinct negative effects as well, most notably the fact that interest rates are very low in the current environment, and that's made it very difficult for conservative savers to generate a fair, safe return on their investment. Additionally, unemployment has remained stubbornly high through this period, and we've also seen GDP growth not as high as one would expect in a recovery that's lasted this long. So we're at an interesting crossroads in 2014. The Federal Reserve has a work still cut out for them from the standpoint that if they decide to tighten too soon, we could have an economic stumble, and that creates a challenge. However, if they keep rates too low for too long, It could also stoke inflation. We think we have ways to position our portfolios for this environment. We recognize the environment we're in. So I'm going to hand it over now to Jim Rhodes, who's going to talk about the investment implications of our big picture view.
Okay, thank you, Mike. Now, if you turn to page 4, in terms of the global equity markets, and as you know, the U.S. equity market has been doing very well, much better than what we're seeing in international developed markets and also in emerging markets. Although we feel that the U.S. equity market is not overvalued, but we do feel that after 5 years of very good equity performance numbers that certainly the U.S. stock market is fairly valued. There are risks, of course, and that's why we've always had about maybe 4/5 of your equity exposure in the U.S. and maybe 1/5 outside the U.S. But we think it's time to address that relationship and probably push some of the U.S. fund holdings out into these better valued markets. Now, if you turn to page 5, you'll see a table of statistics, and I'm not going to walk you through all those, of course. We have 2 price to earnings ratios, or PE ratios, being shown. One is the Shiller ratio, and the other is the trailing 12 months PE ratio. And I can't, because of time, go into a great deal of background, but let's just say that if you look at these 2 measures, which have been helpful over time to identify undervalued and overvalued markets, that this is a time where the U.S. market has only been more highly valued in 1 out of 4 years, or 1 out of 4 instances. In Europe and Japan relationships, they've only been better valued 1/3 of the time. And in emerging markets, actually, they've been better valued only about 10%. So as we go through our classification, as we go through our evaluation of where we want client portfolios to be invested, we think it's time to start taking some profits in the U.S. and moving that money to Europe, Japan, and some of the emerging markets. As I say, there are risks involved, and we're not looking to do a large wholesale reorientation of portfolios, but we think looking out over 10 years, there are better values in these markets. And that's what these statistics are showing. On the next page, 4 bar charts for each of the asset classes. It shows a year-to-date performance figure, last year's performance, a 3-year performance figure, and then how these assets have performed over 10 years. We're just going to concentrate on the 3-year figure, which is the beige-looking or light yellow-looking chart. And what we find is the underperformance of the emerging market is helping valuations in the emerging markets are so attractive right now. And yet most economists still are very positive about the emerging market economies and therefore the earnings that can grow to companies within those markets. So here again, if you look at that 3-year bar, you'll see that the U.S. is by far the best performing asset class, followed by foreign or international developed, and emerging is still negative for the 3-year period. So that's part of what's behind our looking ahead. You always have to look ahead in investments and not in a rearview mirror. So looking ahead, we feel better return opportunities by starting to slowly shift out of some of our U.S. markets. Now lastly, I did want to touch on diversified asset class. And we've been holding a commodities exchange traded fund and a gold exchange traded fund in the portfolio for a long-term inflation hedge and also for diversifying our traditional investments of stocks and bonds. And now to cover the fixed income part of the market, here's Mike Moore again. Mike?
So the third primary asset class we look at is the fixed income asset class, also known as bonds. There's been a lot of talk about the bond market recently, given how low interest rates are. If you turn to page 10 of your handout, we have a long-term chart of the U.S. Treasury, which is, you'll see after peaking in the early 1980s, it's really been a steady downward slide in the interest rate on the 10-year Treasury. As the interest rate goes down, the price of the bond goes up. So you could call that a great bull market in bonds that we've had over many decades now. So as we look at the big picture today, we're concerned about the possibility of rising rates and are really focused on trying to position bond portfolios for that eventuality. Now I'll step back first though and say that there's been a lot of questions that we've had over the years about, well, why have any bond exposure at all? We think it is important, especially as you get older. If you're a near retiree or retiree, bonds do serve a purpose in the portfolio. First and foremost, they have a fraction of the historical volatility of stocks. So, if you're an investor in bonds and you can hold to maturity, you're going to have likely a smoother ride than you would being in stocks. We do think bonds are an important component of a nicely balanced portfolio, but the environment that we're in after such a long bull market in bonds is one where we feel we need to do a few things to try and protect the portfolio on the fixed income side. First and foremost, we want to keep the maturities, the average maturity of a client's bond portfolio relatively short term. We would target that as being 5 years or less on average. And the reason we do that is the longer the maturity, the more a client is exposed to interest rate risk. For example, a 10-year treasury bond, if interest rates were to rise only 1%, the principal value of that bond would decline by over 8%. So the shorter the maturity, the less of that kind of price effect a client will have. Number two, we're looking at investing in what we call a strategic, a looser description is a go-anywhere kind of bond fund, where the manager has significant leeway into trying to take advantage of various mispricings in the bond market and various strategic opportunities. These bond funds, on average, the ones that we've invested in, tend to have very low average maturities, very low sort of interest rate risk profiles. So we think that's an important area to have exposure to. Thirdly, we think it's important for clients to have exposure to floating rate notes. They tend to have higher yields than you'd find on the strategic income funds. The good thing about floating rate notes is as interest rates rise, that floating rate floats higher. So it is one of the few fixed income asset classes or assets where a client can actually have an increasing principal value on rising rates. Lastly, we are calling this what we call a loose hedge. We are investing or hedging a portion of the client's portfolio using inverse treasury funds. Now what that means is as interest rates rise, these funds will also rise in value. So they're making a bet against bonds. And so that helps in our view to hedge some of the short intermediate term bond exposure we have. And I will go ahead and hand it over to Jim to wrap it up.
Okay, well thank you, Mike. And that wraps up our little DVD presentation. We hope you found it informative. Of course, we definitely wanted to keep it informal, but we hope you've learned something about how we're positioning your portfolios today. And we really want to be open to your comments and suggestions. Should we do this kind of report again? How often? Thanks for watching, and we'll talk to you later. Bye-bye.